Are we facing a turning point in our financial landscape?
We have a treasure trove of insights from experts like Joseph Wang and Peter Boockvar lined up for you.
And the best part? We provide all the critical points in just minutes.
Exactly. Discover the risks tied to the latest CPI report and its impact on your investments.
Welcome to Financial Insights in Minutes, where you get a quick take on today's financial news.
And stay tuned for a deeper dive into a market overview of November 9th with insights from Joseph Wang.
Let's unpack what this surge means for the markets.
Wang believes this is just the beginning of significant changes.
What's the core assertion here about Trump's victory?
Wang emphasizes the strong electoral mandate for Trump's agenda.
How did the markets react this week?
Equities surged, particularly tech stocks like Tesla.
What about Trump's tariff plans?
He believes tariffs will incentivize companies to manufacture in the U.S.
And what's happening on the tax front?
There's talk of renewing tax cuts, which could boost growth.
What does Wang see for the future economy?
He anticipates growth, but warns of potential trade tensions.
What's the main takeaway from today's insights?
The markets are optimistic, but could face uncharted territory ahead.
Today, Peter Boockvar breaks down what a Trump victory could mean for the bond market and equities.
He emphasizes that this outcome could lead to rising bond yields and complex economic dynamics.
What's the core message from Peter?
He believes that bond yields may rise significantly under a Trump administration.
What are the implications for investors?
Investors may need to adapt to a new economic reality characterized by fluctuating yields.
Peter describes the U.S. economy as a two-lane highway. What's in the fast lane?
The fast lane involves tech-driven growth, particularly through AI and high-income consumer spending.
And in the slow lane?
Manufacturing struggles and low-income consumers are facing significant challenges.
What's Peter's concern regarding interest rates?
He's worried the bond market might be experiencing a massive unwind as yields rise.
If yields do surge, how might that impact stocks?
It could compress multiples, raising concern for stock valuations.
How will regulatory changes shape market behavior?
Regulatory easing may support financial stocks, but overall it remains uncertain.
What businesses could benefit?
Financial and energy sectors expect advantages, but sustainability is key.
What should investors expect in the near term?
The market might see increased volatility, especially if interest rates keep rising.
What about the longer term?
Regulatory changes and inflation expectations could reshape investment strategies.
So, what's the main takeaway for investors?
Investors should be prepared for potential volatility as economic conditions shift.
It sounds like a balancing act.
Absolutely, staying informed is critical in these unpredictable times.
Today, we're unpacking the huge gap up with Tesla. What does it mean for traders?
This surge raises questions about market momentum and possible pullbacks.
What does this mean for broader market sentiment?
It could signify strong buyer interest, but caution is key.
A 17-point jump in Tesla. How does this affect overall market dynamics?
Such significant movements can cause a ripple effect throughout the market.
What key events should traders keep their eyes on this week?
The CPI report is crucial. It can shift market expectations dramatically.
How should traders adjust their strategies in light of this information?
Flexibility is key. Adapt to market movements and news reports.
What could the CPI report mean for market behavior?
A stronger than expected reading could lead to significant sell-offs.
So what's our key takeaway from today?
Be prepared. Economic shifts can lead to unexpected market reactions.
Let's dive into alarming consumer trends with Steve Van Meter.
The data reveals unsettling trends in credit card usage.
What's the significance behind the stagnant credit card usage?
It's a clear indicator of consumer anxiety and economic slowdown.
Could this mean we're on the brink of something larger?
Absolutely, we might be looking at a deeper recession.
What do these trends in credit card spending indicate?
They show consumers are pulling back, fearing for their financial stability.
Isn't that a strong signal of economic distress?
It certainly is, and the data supports that sentiment.
How does the Fed's recent behavior reflect economic conditions?
Their actions reveal underlying anxiety about economic health.
But aren't they projecting confidence?
Correct, yet the rate cuts suggest imminent concerns about growth.
What do the jobless claims reveal about our economy?
They indicate deeper issues, like underemployment, not just unemployment.
Is this causing more consumer caution?
Definitely, when jobs feel uncertain, spending declines.
What does the future hold if these trends persist?
Without intervention, we could face a prolonged economic slowdown.
Might consumers hold back even more?
Exactly, as fear becomes a larger driver of behavior.
What's the ultimate takeaway for viewers?
Monitor consumer behavior closely. It's our best economic indicator.
So we should remain vigilant for changes.
Absolutely. The path ahead looks rocky without consumer spending.
Today, we delve into Danielle Park's insights on why she believes stocks are highly overpriced right now.
That's right. And her assessments are particularly illuminating given her experience managing wealth for high net worth families.
What does Danielle say about current market valuations?
She points out that we're witnessing the most inflated equity prices in decades.
Is it possible for these prices to hold?
That's highly unlikely without significant economic backing.
How alarming are current valuation levels?
Very alarming, as compensation for taking equity risk is at its lowest since 1925.
What does this imply for investors?
It suggests that investors might face substantial losses in a downturn.
Danielle seems skeptical about AI as a panacea, right?
Absolutely, she believes it won't rectify the deep issues in the economy.
Is central bank intervention enough?
Not really. It hasn't proven effective in stabilizing the core economic problems.
What do recent job statistics indicate?
They hint at a weaker job market reliant on government positions.
Could this be a precursor to a recession?
It's certainly a possibility that cannot be overlooked.
What prediction does Danielle make about markets?
She anticipates potential significant corrections based on current valuations.
What should viewers be cautious about?
Both equity risks and the unsustainability of current market dynamics.
What should the main takeaway be for investors?
To be prudent and reconsider their reliance on inflated asset prices.
A time for thoughtful investing is right now, isn't it?
Indeed, a complete reassessment is critical in these volatile conditions.
We're delving into the significance of this week's CPI report. How will it impact the market?
The timing is crucial, especially for the bond and currency markets.
What's at stake with this CPI report?
Analysts expect a 0.2% increase, but the swaps market predicts higher.
What would that mean for investors?
It could lead to rising rates influencing overall market dynamics.
What do the current inflation figures suggest?
We're seeing CPI expectations shift, hinting at possible volatility.
How are the swaps reflecting this?
They indicate a potential month-over-month increase that could set new benchmarks.
How are interest rates interacting with CPI?
If CPI surprises, we could see rates push higher.
And how does that affect the investment landscape?
Higher rates usually lead to more cautious investment strategies.
What about the potential effects on risk assets?
A stronger dollar could pressure prices across the board.
So higher rates could mean cautious trends for stocks.
Exactly. Investors will likely reassess their strategies.
What does the future hold following this report?
Inflation may rise further, potentially reshaping market strategies.
And how should investors respond?
They may need to consider more defensive positions.
What's the take-home message for investors?
Stay alert for CPI outcomes. They're vital for future strategies.
A lot riding on this data, isn't it?
Absolutely. Investors must adapt quickly to market shifts.
What a roller coaster ride we've had hearing from our financial experts today. They've shared key insights into the current economic landscape.
Absolutely. Joseph Wang teed off by pointing out how Trump's election could inspire significant movements in the markets, especially looking at bond yields.
And Peter Boockvar raised an important red flag about rising bond yields, which he argues might shake up the equities market.
Meanwhile, Danielle Park emphasized the seemingly over-the-top valuations of stocks that could spell trouble for investors.
Steve Van Meter's analysis further highlighted consumer anxiety reflected in credit trends, definitely a key consideration.
Exactly. And Matt tied it all together by noting how Tesla's movements could indicate broader market sentiments.
If you found this discussion valuable, be sure to give us a thumbs up and subscribe for more insights just like these.
Your support helps us keep bringing you timely updates on the ever-changing financial landscape.
And don't forget to check out our other videos for more deep dives into trending financial topics.
Thanks for tuning in to Financial Insights in Minutes. Stay informed, and see you in the next episode.